A couple of weeks ago, I had the opportunity to attend some of the most intensive capital markets conferences available on the West Coast, the Vancouver Resource Investment Conference and the Metals Investor Forum. These conferences were not social media clickbait or just doom and gloom. These were real capital allocators, geologists, miners, institutional investors, and people who deploy money for a living. And despite the different number of speakers coming from all perspectives and the number of different mining opportunities in the junior space that were there, the message was radically consistent. The world is uniformly moving away from fake paper promises into assets with real scarcity. And not because it necessarily wants to, but because it's being funneled into that direction. The global financial system, as it stands right now, has relied on the dominance of a single asset, the faith and confidence in the U.S. sovereign debt. That is, U.S. treasuries. Central banks around the world hold these U.S. treasuries in order to provide the reserves for their currencies. And remarkably, these U.S. treasuries have been slowly replaced over time with real physical assets, gold and silver. Now, the U.S. government could, in the past, borrow endlessly without consequence because the world central banks were buying their bonds. In short, this global financial system was based on the U.S.'s ability to export inflation. But this shift away from U.S. treasuries and into hard assets by central banks around the world is creating a dynamic shift. And it's a quiet, subtle shift that most people around the world are missing. Foreign demand for U.S. treasuries, that is, U.S. government debt, is not what it was in the past. Now, 25 years ago, 75% of the global currency reserves were backed up by U.S. treasuries. And that number is now falling. In fact, U.S. treasuries are now in second place compared to gold and silver bullion held in the vaults of central banks to secure their reserves of currency. Now, this has created, in the words of some of the speakers at these conferences, a debt feedback loop. As foreign demand drops on these U.S. treasuries, yields must increase to attract other foreign buyers. Higher yields means increased interest costs. Increased interest costs means more borrowing just to pay the interest on the debt. And more borrowing makes that debt less attractive overall. We've seen this repeatedly in not only the US financial statements, but also the Ministry of Finance here in Canada produces financial statements where the increased interest costs are rising every year, and they're rising dramatically. Now, this debt feedback loop is becoming an infinite problem because during times of economic prosperity, the governments never paid attention and never paid down or off the debts. And the consensus at the conferences among the speakers was the window was closing on being able to correct this because the debt is now spiraling out of control. In 2008, the U.S. federal debt was $8 trillion. And today it's closer to $38 trillion. Even if we applied the same prevailing overnight rates or interest rates on these treasuries, we're dealing with an interest cost that's 5 times the problem of 2008. Fundamentally, we are sitting in a different global financial system than we were 15, 20 years ago. And this raises the question or the point that things are unsustainable and they can work until they don't. This is why governments and central banks around the world are shifting away from what can we do to replace the US dollar to now how do we protect ourselves if the system fails. This is not merely theoretical. We're seeing the cracks in the system now. So one of the main things that central banks around the world, as I mentioned before, has been taking a larger and larger position in physical bullion, gold and silver assets. Now, to be clear, this isn't in the form of an ETF or a silver contract or a gold contract where you have a redemption right on that physical bullion. They are investing in the physical metal themselves. Central banks around the world have reported purchases of gold in thousands of tons every year. And it's widely speculated that central banks are not publicly reporting the actual volume of assets that they hold. And to be clear, they're not doing this to return to some sort of gold standard. They're doing this to hold neutrality. With U.S. treasuries, you have counterparty risk. That is the reality that the US government may not be able to make good on its interest payments. Meanwhile, gold has zero counterparty risk. If you own the asset and you own it physically, you're not relying on a third party to determine its value. Gold doesn't rely on payment clearing systems. I think this is one of the big things with cryptocurrency, is that it was supposed to get around the SWIFT payment system, but neither does gold. And gold does not require permission. What this basically means is that if you have the gold, you make the rules. In my opinion, gold isn't being held to preserve the old system. It's being positioned to create a new one, and that distinction matters. One speaker in particular was talking about how there is a double monetary system starting to emerge. The Shanghai Index and the Chinese vaulting system is now being placed around the world, circumnavigating the need for the dependence on the US dollar globally and moving into a gold reserve system. The idea that gold can be used for trade is a real and visceral possibility now. And this may replace a decades or even century-old tradition of oil being placed in US Texas crude prices. Now, for decades, the Western financial system has been relying not on gold, but on receipts for gold. That is, paper claims, ETFs, and futures contracts that have been the redemption rights for gold, and not the gold itself. These gold papers, or these futures, or these ETFs are enjoying the rise of the commodity price, but they're really worthless if everybody runs out of the gold to redeem it. The reality is there could be multiple claims placed on the same source metal. And the further, more terrifying reality is that derivatives could be created against the paper claims. It's rehypothecation layered on rehypothecation. And it's worked for so long because almost nobody is asking for the redemption of their gold. Now, that assumption was tested back in the late 1960s by Charles de Gaulle, who was redeeming paper claims against the US treasuries and their gold reserves. And it's widely speculated that that pattern, those transactions, forced Nixon to close the gold redemption window on US dollars. And that happened in August of 1971. But today, that assumption seems to be going through another test.
Yeah, thank you. Well, I would actually say that despite gold being above $5,000 per ounce right now, it's at a new all-time high. Despite that, when we study the history of the stock market versus gold, that was the topic of my talk right here. The stock market versus gold. Gold has just in the last month broken higher compared to the stock market from a 12-year base, a 12-year consolidation, where basically during that whole period of time, the stock market and gold were moving one-to-one in lockstep. Gold in the last month or two has just distanced itself enough from the stock market for us to say that this is the start of a new major trend.
Right.
So as hard as it is to believe, with gold above $5,000 per ounce, the distancing process has just begun. And it looks to me, I mean, if we just rewind to where gold versus the stock market was back in 2011, which was the last major peak for gold at 1,900 per ounce, if gold achieved the same level today versus the stock market, it would be $9,000 per ounce.
Wow.
And so that is a realistic expectation for the next 12 to 24 months.
Now, if you contrast the gold and silver futures market, paper, ETFs, and futures contracts, and you compare that with the physical settlement ability for people who have the gold, that paper leverage loses all of its control, supply constraints become visible, and trust shifts away from the intermediaries of the gold right back down to the physical metal itself. And this is why countries are repatriating their gold, not for symbolism, but rather for control. Because let's be honest, if access to the contractual assets that you have the right to claim are delayed, restricted, or deferred, your actual ownership of the metal is conditional. And in an environment where there's geopolitical uncertainty and trust is eroding, conditional ownership is no longer enough. Now, while gold has risen over the last 12 months by 100%, silver, on the other hand, has risen by 300% of the same time period. The reality is there is a higher industrial need and demand for silver than there is gold. Electronics, solar, and military operations and applications all demand silver for their industrial production. We also know that silver production annually is very limited, and they are running out of a major amount of supply. Recycling can only reuse silver so much, but meanwhile the industrial demand continues to expand, especially with the markets we just mentioned. Now, in my view, this isn't so much of a narrative of a short-term silver squeeze. When you compare industrial demand and lower inventories, this is a structural mismatch.
So I think that the market's starting to realize that silver has been in a deficit for the last 5 years. There's no new meaningful mine supply coming to market. The deficit has been in the range of anywhere from 10 to 20% per year. So that's just sort of mostly driven by industrial demand. And now what we've seen is that with the market coming to terms with that, and investments starting to flow in, silver follows gold, and we've seen that happen just now. Silver is often considered sort of the poor man's gold. Maybe not so much anymore at $114 silver today, but I've often said that silver will follow gold, and when people start to pay attention to gold, and gold, at $3,000-$4,000, and people wanting to get into gold and seeing that, it's really gotten quite pricey for an ounce of gold, they look for an alternative. Silver is usually that alternative, and so back maybe beginning or the middle of last year, when you could still pay $35 or $40 for an ounce of silver, it looked pretty attractive. And so all of these factors are coming together. Silver was deemed a critical mineral by the U.S. Late last year. They import 43% of all of the silver that they consume, and China is refining 60 to 70% of the world's silver. And they actually increased a ban, or they've restricted the amount of silver that they can export every year. So, and they consume a lot of it because they build or they manufacture 80% of the world's solar panels, which take 20% of the annual silver supply. So these are some things that are really driving everything, and I think that it's definitely a market to watch. Now, it's gotten pretty crazy in the last few weeks. It took 45 years for silver to reach its all-time high once again at $50, and then it took 3 months to go from $50 to $100, and we're at $114 today. So there's a lot going on, a lot of factors. I write a newsletter that focuses on silver mining stocks exclusively. It's the only newsletter actually in the space that does silver only. So if you're looking for some guidance in terms of where we are and where we're headed, I think actually the next opportunity in silver is going to be the miners versus the metal itself. So stay tuned for that.
Now, to get a new mine online, this isn't just as simple as walking through the park and starting to dig. There's a whole process of exploration, digging, researching, permitting, getting the infrastructure in place, getting the capital in place, and then you can start digging the metal under the ground. So when paper leverage meets physical constraints, price discovery has got to break. The exact timing of these moves of prices of silver is unknowable, but the direction is not.
Well, first of all, I want to say first and foremost to all those investors who stuck it out all those years, congratulations, because this is your time. What are my thoughts on silver? I feel that silver has finally broken free from its chains, and that's why we're seeing cheap price reflection in silver. And I wouldn't be surprised to see silver north of here, 120, 130 within the next 6 months.
So the price of silver has been rising dramatically, especially over the last 3 months. And why? Because paper no longer has control and leverage over the silver market. In fact, even Canadian banks are sitting on shorts, silver shorts, that they can no longer transact. And therefore they're losing a lot of money. JP Morgan in the States is apparently sitting on a $6.2 billion short in silver, and they're going to lose that position.
Okay, so let's talk about silver for a moment. Silver was consolidating for 45 years. below the 1980 peak. The 1980 peak was $50 per ounce.
Right.
Silver was consolidating for 45 years below that level. And the way to think about such a long consolidation like that is that there's all this buying and selling and buying and selling and buying and selling. And so metal gets transferred from weak hands to strong hands during that long 45-year base. And so then what ends up happening from a physics standpoint, it's just like if you spent a long amount of time building a base camp at, let's say, Mount Everest. You're planning to climb Mount Everest, and you spend a long time building your base. You're going to be able to go higher eventually because you've acclimated, you've gotten ready, you've prepared yourself. The markets function literally the same as other examples in nature, both the natural world and human nature. And so this 45-year base for silver is truly a once in a multi-generational move that is happening right now. And so seeing silver go from 50 to 110 in just about 2 months, yes, I mean, at any point, could it drop 10 or 20 or $30, a short-term correction in a matter of a week or two? Absolutely. But after a 45-year consolidation, this thing is going into the mid triple digits when we fast forward several years from now. A market that consolidates for 45 years does not finish its upward move in just 2 months after the breakout point.
Now, gold and silver weren't the only two things that we were talking about at these investment conferences. Two other themes really seem to rise to the top, which is copper and uranium. Copper is a rare earth, critical mineral that is at the center of AI development, power grids, data centers, and manufacturing altogether. And just like silver, copper is facing the same inventory shortages, which is going to bump demand. Again, the timing of the price move is unknowable, but the direction is not. Higher prices are no longer mere speculation. It's a required adjustment to bring supply back online. And uranium tells a similar story. The reality is that AI and data centers have changed the demand for copper and uranium dramatically. Intermittent energy doesn't work for these base load computation centers. Nuclear energy does. And that puts uranium square in the sights of the next phase in development and mining. Now, you couple all of this with the announcement by the US government recently, back in November of 2025, to release or at least update the critical minerals list, including silver on it for the first time. The US government infrastructure is now being focused on pouring billions of dollars of investment into the copper, uranium, silver, and gold markets. And specifically, the major benefactors of those will be the mining industry. At the same time, the best investment advice offered at these conferences was to be disciplined. Nobody has ever lost money realizing a profit. So don't confuse strategy with tactics. And in the event of a price correction, this materializes opportunity, not necessarily risks. As my friend Rick Rule said, getting a hunch and betting a bunch just simply doesn't work. But one main reminder stood out. Paper assets are proxies for physical reality. And when the world reprices scarcity, those prices are going to move quickly. Look, the reality of this video is it's not fear-mongering. It's about having the proper alignment. The reality is that large amounts of capital are moving away from promises and moving into something physical and tangible. Gold, silver, copper, uranium, real assets. And this isn't because of some hate on for any particular country or because of ideology. It's because of the incentives involved. And history suggests that those who get on these shifts early enough don't just preserve their capital. They will be the ones to help shift the new cycle. If you found this video to be helpful in your journey, your discovery of financial literacy, politics, economics, history, and philosophy, make sure you like, subscribe, and hit that notification bell so you can watch our upcoming videos.